Hey, welcome back. This topic is about debt. Can anyone tell me what debt is?
Well, I've got some student debt left over from university and I use a credit card.
I've got a mortgage.
Right. All these examples are forms of debt, which simply means that you have an obligation to repay what you have borrowed, normally with interest. Over the last couple of decades, the banks have become quite clever at packaging these types of consumer debt up and selling them on. It was this practice that was at the heart of the financial crash that started in August 2007. But we won't be covering this at these courses.
Okay, so how do I trade Ryan's student debt?
Well, as a private individual, it's very hard to trade this type of debt.
And I'm not sure you'd want to.
It's really only institutions and hedge funds that have access to these new debt markets. However, debt that you can trade are called bonds. When a government or company wants to borrow money, they can issue bonds.
Okay, why issue a bond?
Corporations often borrow to grow their business. They issue bonds to fund profitable projects.
And why do governments use bonds? Is it for the same reasons that companies do?
Well, governments spend the money raised by issuing bonds on different things. But yes, essentially it's the same. They are borrowing money that has to be repaid one day. Governments need to fund roads, schools, other public infrastructure. Sometimes they borrow to fund day-to-day spending.
Okay, just so I'm clear on this, a borrower issues a bond to an investor who is effectively the lender. The investor lends an amount of money, so what's in it for them?
Well, the issuer will pay the investor interest in order to compensate them for the risk of lending. For bonds, this amount of interest is normally a fixed percentage per year, agreed when the bond is first issued. The technical term for this payment is the coupon. Most coupons are paid once or twice a year.
Okay, that makes sense. What about paying it back? I don't finish paying off my mortgage for 15 years.
Well, the length of term is agreed when the bond is issued. All bonds will state when the amount borrowed is due to be repaid. It's known as the maturity date. You can get bonds issued with a short maturity, such as a year, all the way up to 50 or even 100-year bonds, but these are pretty rare.
So if we know what the interest rate will be, when the interest will be paid, and the maturity date, does this mean that the borrower can anticipate the exact amount of cash they will receive?
Exactly. Bonds are often referred to as fixed income securities because the investor can anticipate the exact amount of cash they will receive if a bond is held until maturity. Let's look at a simple example. Say you buy a corporate bond with a face value of £100, a coupon of 5% per year paid annually, and maturity of 10 years. This tells you that you will receive £5 of interest per year over the next 10 years. Over the 10 years, you'll receive a total of £50 in interest. When the bond matures in a decade, you'll get your £100 back.
That makes sense. But with all the variables fixed, why bother trading it?
Good question. Well, let's take a look at our example. Say after 1 year, the central bank lowered interest rates, or as it's more commonly known, the base rate.
Yes, I've heard of that.
And instead of 5%, the company wants to borrow the same amount again from the investors, but this time they can get a rate of 3%, all things being equal. Remember, you own the original fixed rate bond paying you 5%. A logical investor would be happy to pay you more than the £100 you invested because it's generating a better return than they can currently get by investing in the 3% bond. £5 interest a year versus 3. There are huge markets for this type of bond transaction after the bond is first issued. They are called secondary markets. In our example, the secondary investor might buy the bonds for about £115 and they would still receive the £5 a year. If you divided the annual coupon by the market price, which is in our case 5 divided by 115, you get the yield.
I think I get it. It's a bit complicated.
Don't worry, if you study bonds and eventually trade them, I promise this jargon will become second nature.
Okay, I'm keen to learn about them.
That's great. For now, you just need to know that all bonds have a market price and a country's base rate has a big impact on it. A general rule of thumb is if interest rates fall, bond prices go up.
So that wraps up the overview of debt and asset classes. I found that really useful.